Hey, we're live. We're live, Richard. June 24th. It's a beautiful, beautiful, beautiful sunny day here in Andorra. And you know what? It's been crappy weather for, it seems like forever. So it's a big reprieve for us to finally get some nice weather. We got some big things happening in the world today, don't we?
Yeah. So, I've just spent a week in Portugal racing fast cars around the place with a bunch of friends. And of course, I go away for a week, and what happens? Well, Bitcoin melts up by 25%, and civil war breaks out in Russia. I'm getting this happens every time I take a holiday.
Yeah.
Something like this.
Have to chain you to your desk or something, so we get more stable price action. So yeah, it's interesting developments. I'm not saying it's a civil war yet. Certainly, there's a type of a rebellion. I don't want we don't want to get into the politics of stuff here, but interesting developments for sure, and a lot of confusion right now. But over the coming days and weeks, as things play out, it'll be very interesting to see what happens. And on that note, because we're traders, it's like, okay, any world event, doesn't matter what it is. We're forgetting about one of the big things that happened this week, the potential Zuckerberg-Musk fight. And, Dana White, the president of the UFC, came on and said that it's a go. Whether it is or not, we'll see. But he said that it could be the largest pay-per-view event ever in the history of the world, and I wouldn't doubt it. And it could raise hundreds of millions of dollars for charity. So it's interesting. But everything that happens in the world, if there's a way we can trade it, let's figure out how we can trade it. So discussing the the potential problems that they're having internally in Russia. We're going to run a little poll here. What would civil war in Russia mean for Bitcoin prices? Now, I'm not saying it's civil war yet. We're just saying if that happened, do you think they could go up, down, or would it have no effect? So that poll is published now. Go ahead and put in your thoughts and let us know what you think what would happen to the prices of crypto assets. All right, so just checking how we got some people on with us. Great. Hey, hello, Alwyn, Def, Luke, Gendrea. Hey, good to see the Italians are here again. Richard, have you ever been to Lake Como?
I have. Yeah.
No, I've never been there. It's one of those kind of places I feel like I need to go to. And
it was Pliny the Elder's favorite place.
Oh.
I have a friend whose father lives there.
Oh, yeah, nice place.
Very humid, but it's very sort of damp atmosphere. So it's probably great on a really beautiful summer's day when the sun's right down on you, but there's a lot of mist around the lake, so it's quite picturesque.
Interesting. Probably not as misty as Loch Ness or something. I'm guessing.
Yeah,
a little nicer than that. I think we may as well get going here. It's 5 after. We got lots of people joining us. Great to have you with us, everyone. Let me just bring up the slide. We'll give you the agenda for today, and then we'll get into some trades. Where are we here? Trading crypto options, the pros. Hey, that's us, the pros. just in case you're wondering. So today we're going to talk about the current market analysis, and finally we've got something to talk about. The last couple of weeks there hasn't been a heck of a lot going on, so we've got some action now. That's great. So we're going to talk about some of our current trades, review those and the strategies that we're looking at right now. And then we're going to talk about covered call campaigns, just specifically covered call campaigns. We're talking a little bit about choosing strike prices. I think choosing strike prices is one of those questions that comes up all the time. It's like, well, okay, I can do this, but what strike price do I choose? So we're going to talk a little bit about that. So let me stop the slides, and I'm going to go ahead and share my screen. I'm going to get straight into what positions I've put on since basically the beginning of the week when things started to roll, to rock and roll. So let me just go and share this now. Can you see my ETH silly chart?
I can, yeah.
Now, the first thing I want to mention is, I call it my silly chart. Why do I call it my silly chart? Because I've got two lines on it. 2 lines. That's it. Now, I've taken those technical analysis courses. So one could say I'm a technical analyst, but I don't rely on it except for a very macro thing. Now, if we're trading micro, if we're trading 0 day to expiration stuff, if we're scalping, then indicators can, you get all kinds of indicators. That's good. But I just want to point this out. Just look at this Ethereum chart. I drew this way back. I don't know, let me turn the little whiteboard on here. I drew this way back probably, it's not working again. I'm not sure why. Anyways, you can see my mouse, right?
Yeah.
Somewhere around here, I drew this. I said, well, this is the line. And whenever you're doing anything with technical analysis, you need to look to your left. You look to your left. So you look at the past to give you ideas of what's going to happen in the future. So I drew these lines, and I used to have a unicorn down here. I think I still got it on my Bitcoin chart. Yes, I do have my unicorn on the Bitcoin chart. I've got the unicorn over here. But take a look at this ETH. I drew this line, and a few times it came down here, and someone said, "Ha, Shane, your chart sucks. It's not doing anything." Well, looky, it stuck right to it. This is just some line I drew. It broke it and came right back to it, and then we bounced up from there. So I know Richard thinks that, technical analysis is a lot like, reading burnt animal entrails or things like that. But let's take a look at the Bitcoin silly chart. Here's my unicorn down here I was looking for. We haven't gotten the unicorn. In fact, we've gone the other way. Maybe we'll never get the unicorn. I don't know. That's okay. We'll have a new unicorn at some point. But look, it came right down to the line, like literally right down and bounced off that line. Isn't that kind of amazing? Is that just a sheer coincidence, Richard?
Yes.
Okay. Boy, one coincidence after another. That's incredible. Okay. All right. So let's talk about, let's go to Ethereum first. Now, because the whiteboard was acting up a little bit earlier on me too. I'm not sure why it's not working here, but I can draw on this chart itself. So anyways, what did I have on? Well, before this thing started down over here, before this rally started, I did have some June 30th short calls around 1,900 level. So if I get my little thing right around here, actually, this is about $1,900 right there. Now I did have those. As this thing moved up hard, I did roll those out to the 1950s. So I rolled them up to about, there's 1950s right there, to June 7th. I still got those. And I did that for a flat trade. So it didn't cost me anything. And I didn't get paid anything. It was relatively flat. So that's all I've done there. So maybe I'll just go ahead and add a new one here. So there we go. If I change this color, you'll see that, just make it red. There we go. So I ended up selling that and opened a new one above. So this is actually part of some covered calls. I'm not worried about these. I didn't have a lot of positions on with either Bitcoin or Ethereum because volume was really low. When we were down here, volume was low. We were just playing light because we didn't want to get stuck in anything. If we knew something was going to happen eventually, whether it was in 6 days or 6 months, who knows, right? So that's what I had going on there in ETH. What was the next thing I had happening? Let's see. Short June 1,900 calls, rolled them flat. Yep. Now I did have some June 2,100 shorts as well. So 2,100 way up here. Come on, work. There we go. Those are June 30th. Okay. 2,100 shorts I had up there. Now those were, I just added to them. I didn't do a darn thing with them. As things were moving up here, this is kind of scary. We're like, oh my gosh, you can keep going forever, right? And they could have, who knows, right? All I did was I added a little bit more to that position, that short position. Those calls were around 65% IV at the time. And what I did was I actually used the proceeds of those to buy some July and monthly July. So July 28th, I think is the expiry in July. They were trading around 45% IV. And I think those were 1,700 puts. So I sold some down there and then I used the proceeds to buy some puts somewhere down here, which go out to to July. Why did I do that? Because I didn't know if this rally was going to keep going. I mean, maybe we're going to keep drifting up for the next 6 months. I don't know. Who knows? We could retrace this. I don't know. I don't try and predict the markets. But when puts are cheap, I try and buy them, and they were free. I sold these. I felt pretty comfortable with these up here. These 2100s that I sold. So I used the proceeds to buy some puts. If they pay off, great. If they don't, it didn't cost me a damn thing. So I'm not too worried about it. What else did I have here? On some other accounts, now I did have some, I sold some 2000 calls for June. Okay. So June 2000s, I sold in some smaller accounts right around here. When we were farting around in this area, they expire, of course, at the end of this week. So I should move them back here. And I did sell some 1950 July 7s as well. So those are around here. I'm happy with these. These are all covered calls. Now, a little portion of them might be a little bit naked. I don't really worry too much about having a little bit of naked covered calls because on the call side, naked calls, because I feel I can usually effectively roll them. If they were heavy, then I'd be concerned, and I wouldn't recommend anyone doing that. I would recommend selling that as a short vertical spread or something like that. Now, Bitcoin, what did I have going on in Bitcoin? I had a short June 30th, 29,000 calls. Okay. Where's the 29K? Right around here, right? Yep. Oops, that was supposed to be a line, not a thing. But anyways, that's the line. Anyways, it blew up through there, right? So I rolled them to 19 to where did I roll them to? 29,500 for a credit. Oh yeah, that's right. This is what I did. Sorry, I'm having trouble remembering what I was doing because there's just so much damn stuff going on this afternoon. I rolled them up to 29, to 29.5. You know, went $500 higher. Then I rolled them up again as this thing kept moving up and up and up. I rolled them up to the July 28th 31Ks for a credit, and that's where they sit right now. 31 is right about there. Okay, so you can see I rolled this twice. I started off here, closed that, started off here, closed that, and now I've got this. It didn't cost me a cent. I rolled them. And in fact, I actually made a little bit of money because the IVs were quite high. I rolled them just before they got to the money or close at the money. And so I'm sitting with this. And now these are Julys, remember. So we've got just over 30 days. So we've got about 5 weeks for these to go. So what am I going to do here? Well, if by July, if this thing blows up and through, we keep trending up and up, well, I'll just keep rolling the darn thing up. Or I might more likely roll it into a strangle at some point. And it might be a lopsided strangle. If we come down, happy days, I'm just going to sit and hold on it and let the darn thing expire because we don't have that far to expire. And time decay is really going to start to become a factor for it. Too sweet. What else did I do? I sold some 34,000 calls and I bought some July 28th, 36,000 calls. Yes, so I did a bit of a spread here. So, and this is in a separate account. So I sold some 34s. So basically here, I sold those at 34. And these are July 7th. Okay, July 7th. And I bought some 36,000. Okay, bought some 36s way out here. July's. Okay, so it's a bit of a calendar spread. These are obviously going to decay a lot faster. I view it's quite high. Who knows if we'll get there. But even if we just start farting around here, and these expire worthless, I'll sell another set of calls against those Julys. I might sell the weeklies against it. I might just sell the monthly against it. So that's all I've got going on over here, Richard. I'm happy to just sit down right now. We've calmed down. It's the weekend, so I mean, let's face it. I shouldn't say let's face it. The last 2 weekends is when we've had some big moves. We've had some big moves the last couple of weekends. So things could happen this weekend. There could be some fireworks and the stuff going on in Russia. There's been a lot of news coming out A lot of stuff coming out of the States. Who knows? But I'm looking forward for a fairly calm weekend. I wouldn't be surprised 50-50 if we kept trending up slowly, or we started to reverse a little bit of this trend, this last move we made over the last week. I'm not saying it's going to reverse completely, but I wouldn't be surprised either way. My margin use is low. I've really not even giving it a second thought about any of these positions. I'm perfectly happy with everything I have on. What do you got going on?
Me, yeah, complete opposite.
Of course.
Just do a quick screen share. Bitcoin. There we go. So here's the Carnage. Well, it actually looks like Carnage, but it's not that bad actually. So first thing to notice. So I was short calls all the way down at 20. We were down at 25,000, right? And we've pumped up about 24%, up to 31,000 in about 3 days, which is that's quite a big move. You see that building up. So the first thing you'll see is, I don't know if you can see my mouse here, my maintenance margin is currently at 61%, which seems high, and definitely don't do this at home, but I'm actually quite comfortable with that. I'm short futures to turn all of my underlying 2 Bitcoins into synthetic dollars, and that automatically takes about 20% off the margin, or uses about 20% margin. Just the act of doing that. So in my mind, I'm actually only using 40% margin, which is still slightly high, but at the end of a 25% rally, I'm okay with that. So you'll notice that I've got a bunch of risk sitting here in 30th of June, a load of calls, half of them are in the money, and half of them are out of the money. I'm not really too bothered about these ones being in the money, because if you look just down here a little bit, you see the Bitcoin 30th of June futures. I'm long. They do it in dollars, so it's $95,000. It's about 3 Bitcoins, right? If I look at the delta, delta, a bit further across. No, delta. Here we go. 3.1. And if you look down in my options positions, you see the 30th of June's net delta is about minus 3.3. So they match off nicely. And what I try and do is keep the options deltas matched off with dated futures, and that's so that come expiry, and particularly for the 30th of June's, which are expiring Friday, I want the options and the futures to expire together, so I don't get any delta mismatches. I also like to keep my net perpetuals negative, because I like to be earning carry. You tend to earn more carry being short perpetuals than you do being short futures. So I prefer to be long futures and short perps, even when the market goes down, oddly enough. So what I'm doing at the moment, this 31,000 call, I used to have 1.1 short there. This morning I rolled 0.3 of it away. So what I'm doing here is I'm just looking to take advantage of the fact that we're now, the at the money vol here is 46-ish, 47. And if I go out to July 7th, I can probably get up to about 30 delta to get 48, or maybe 20 delta, maybe get about 50 vol. So what I'm actually be looking to do over the weekend is just quietly offer these sort of quietly bid for these calls, just 0.1 at a time, and then as I get filled on each one, I'll then go and sell a strangle in either the 7th of July or 14th of July, just to get rid of this sort of at the money position. Because the only thing is about this being at the money, it's fine. It generates me lots of theta, but it's got quite a lot of gamma, and so I really want to control that. I don't really want to be continuously delta hedging with futures. It just burns money. I'd rather just get the gamma lower and push that risk a bit further out. So you can see in my options, my theta line, here we go. I'm earning at the moment $530 a day, theoretically, overall. $300 of it's coming from 30th of June, so that I'm getting that for the next week, and then 153 from 7th of July and 38 from 14th of July. So in my mind, I want to push. I want to push at least $150 of decay out to 14th of July to start balancing up and evening out where I'm getting my my delta decay from. Sorry, theta decay from. These positions have all been written systematically. So these 30th of June's started being written as 10 delta calls way out, sort of 2 months to run. I was writing 30 delta calls as well, and they've all moved up into the money, and they've become effectively strangles because I'm long futures. But to do this, you've got to obviously be on the ball and be delta hedging religiously. Otherwise,
yeah, now Richard, I think that's a good point too. When you with your margin use is so high, it's not bothering you. And you talked about the 20% discount, but also you're hedging.
Yeah, I was going to say, look, if you look at my total futures position, I'm actually long $120,000 of futures on this account contains 2 Bitcoins, right? If you look at my wallet here, wallet, where's the wallet thing? There we are, wallet. So cash balance is 2 Bitcoins. Current equity is 1.6. So what that's kind of telling me is that I'm expecting to receive 0.4 Bitcoins over the next I don't know, month or so in terms of time decay. And so yeah, here I am on a 2 Bitcoin account, and I'm long 3.8 Bitcoins of futures on it, and short a motherload of what's the net delta on the options? 5 Bitcoins of short on the options. So it's all, actually the cash on the account starting to fade into insignificance. What's more important is the sort of net P&L position. And this is not unusual for a book that's been aging and you've been hedging with futures rather than rolling positions. Yes, that's all from me. I think what I'm looking to do here is just roll out those at the monies, and then just sit and wait for this time decay to come in. Just bear in mind that a week ago, this at the money 1 week was trading at about 35% vol. It's currently 46, and it was up to 52-ish, 55-ish, even actually at the end of last week. So I'm kind of personally happy to sell anything above 55 vol on Bitcoin at the moment. So in 1 week I'm probably selling nothing more here, but if you go out to 2 weeks or maybe 3 weeks, 50 vol, 20 delta, 53 vol, 17 delta, 13 delta here at 56 vol. I can sell all that all day long. That's fine.
So. Yeah, and I think too, as far as the upcoming week is concerned, or even the upcoming weeks, the level we're at is, technically, it's where we got stuck back in like May, June of last year, May, June of last year, at this area. So I think that for it to really launch, and it could. I mean, anything could happen. It's the market, right? We would have to have a bit of a catalyst for that to happen, but I wouldn't be surprised if we kind of went sideways for a bit, drifted down. Maybe Bitcoin might go down, $1,000 or $2,000, and just kind of drift around, bounce back up, and fart around. That's how I'm planning to play this. That's why I have not right now a lot of concern of any of the short calls I have. How am I going to play this? Well, I'm just going to I'm just going to sit and wait for that time decay to pay off. If we have a big move down, I will be a contrarian. I will take the other side of that move at some point where I feel it's getting exhausted for a bounce, because I don't think that we're going to break out of the previous range on the downside. That'd be an excellent opportunity, I think, to sell some put spreads down there, maybe even go long some calls or some long vertical spreads. But again, I kind of have a feeling we're going to go a little bit sideways in channel.
The only wild card here is that 30th of June is a big expiry. I think it's the biggest open interest Deribit have seen for a while, maybe even ever, looking at the communications coming out. And it's an expiry where we've seen a whole bunch of... So if you can imagine that like everyone in the world sells 30 delta strangles, and so anyone who's been doing that, has got risk all over 30 June. And I think the max pain number is around about 25,000, isn't it? And they do say that max pain tends to act as a magnet for spot.
That would be very interesting if that happened. Of course, I'd love it because all those calls would just be worthless.
But I'm not so. I'm pretty sure that I think a lot of the traffic we've seen has been institutionally based. I've been watching this. So whenever we get a big move, before it happens, oddly, we see a spike in vol. It always happens in US hours. So I'm almost wondering whether some people are putting big trades on through CME, and then market makers on Deribit are seeing that and replaying it back through Deribit. But for both the big down moves and the big up moves, often I'm seeing like a 5 vol spike of the at the monies in 1 month before the market starts to move, and it's been quite interesting.
That is it. Well, we'll keep our eye on that.
And actually, this morning I saw a strange thing just before 8 a.m. GMT, just before expiry. I saw vols drop from 45 down to about 40 for about 2 minutes, almost as if like one major market maker dropped out or had a glitch in their pricing engine, and then came back in. And for a moment, all my account values jumped like 5%.
Yeah.
So I should have just dove in there and bought everything, but it wasn't quick enough.
Hindsight. Okay. Let me just. I think we've covered sort of what we've got going on. I think we got a basic view of what's happened and how we've dealt with a pretty sizable move over the last 4 or 5 days. So it was pretty exciting. Actually, it wasn't that exciting. It was just exciting because nothing's happened for so long. So it was exciting. But because in the world of crypto, that's a significant. That's a good move, but it's not the move. So
I mean, that would have been an exciting. If you were doing what I'm doing and manually hedging, that would have been an exciting day because you'd have felt pretty exhausted after sort of 36 hours of continuous delta hedging.
Yeah.
It's quite high stakes poker, right? Because I've got a robot there doing that for me, but it traded, probably like $1 million of Bitcoin notional, probably more, and it accrued a $120,000 position over that time, all while I was playing with my kids in the garden and flying from Portugal from Lisbon to Barcelona.
Good thing you got the hedger, because Murphy's Law states, if you've got a position, if something's going to happen when you can't be at the computer, that's just the way it goes. So all right, so let's move on. I prepared some slides. I did up a few slides just to show up basics of a covered call campaign, and I just rounded off numbers just to show a campaign, and that's what we're going to talk about today. And choosing some strike prices. And this is really interesting because covered call campaigns are something that I think are, everyone does them. Anyone can do them. As we discussed last week, doesn't matter the account size you have. Institutional, retail, small account, big account, covered call campaigns can be very lucrative over time. And so let's just take a look at Bitcoin. I just did this based on Bitcoin. So we don't have to worry about assignment and exercise, things like that. And in this case, we're going to just talk about taking it to expiry. So what I'm going to do is I'm going to say, all right, we're going to start this campaign at the beginning of March, and we're going to write the next monthly. So roughly 30 days later, we're going to let that expire. And then as soon as that expires, we're going to write another one for the next month, about 30 days out. We'll just roll that over. I just went back to March. I could have went back to whenever. In fact, I think what Rich and I are going to do is, now that he's back, we might pull some data and look at, okay, what if we did this for the last year and use the actual market data versus just eyeballing it approximately, and where would we be? Where would we have ended up if we'd done this for a year, selling? In this case, I'm selling approximately a 20 delta every single month. So a covered call campaign is just a systemic writing of covered calls for a set period of time. So you could say, hey, I'm going to do a campaign for 6 months or a year or forever. have it forever. I mean, if you own a stock and you want to hold that stock, it pays you a dividend or something. You might just write calls ad nauseum until you get rid of that stock or your sentiment changes on the stock, whatever. The point is just to generate consistent monthly revenue. Okay, so in this case, and I just explained, we're going to be looking at about 30 days out, 20 delta, and 20 delta, of course, because we're using delta in this case as a percentage of profitability. So our percentage of profitability will be about 80%, because 20 delta is saying that the market is saying that there's a 20% chance that that option will expire in the money, as sellers who want it to expire out of the money. So there's about an 80% chance it'll expire out of the money. Repeat it every month, and we'll start in March using Bitcoin. So if everyone can see this okay, basically starting on March 1st, you can see there, and I've got the green arrow. I wonder if my whiteboard will work now. Let me see if it works now. No, it doesn't work. I wonder why. We've got a little glitch in our system here. No worries. You can see the green line starting March 1st goes straight up. And then I've done a green line along the top. Now that top line is 27,000. So that's the strike price. And I've extended it out to March 31st when it expires. So anything that ends up in underneath that sort of little umbrella, if it expires under there, we keep all the premium, right? So in this case, March 1st, we sell the 27K strike. It was around 23,500 at the time. Expiring, we got $400 for that. We collected $400 in premium. Cool.
And actually, before anyone says, if you look at the chart and see that soon after the market dropped to 20,000, and there's a good chance actually that 20 delta call would have been close to worthless at that point. And so a diligent and observant trader would actually have bought that back for super cheap and then rewritten it on the 13th or thereabouts after the rally. Just so that would be a way to increase the gains. But nevertheless, in this case.
And I think what we're going to talk about too, Richard, next week is we're going to talk about adjusting covered calls, because in this case we're just saying, hey, we're going to let it run to expiry. Yeah, at there it would have been worthless. We probably would have bought it back. And whether we would have waited to the end of the month to sell the new ones, we stay on schedule, or we would have sold a new one right away, I don't know. But either way, that's what happened. And of course, all the stuff to the right, we don't know that happened, right? We have no idea where this thing's going to go. Right after March 1st, it looks like it was going straight to zero, right? So crazy. We never really know. But if we forward to the end of March, we can see where the blue arrows pointing where it expired. It actually expired above our strike price, which is what we don't want, right? Interesting. So we, quote unquote, lose $800, which is the market price of 27,800 minus the strike price of 27,000. But you have to remember that we're gaining on the underlying asset, which went up about $4,300. So the upside risk is really only that we're going to not participate in market rises beyond the short strike. That's why I say we lose in quotation marks. It is a cash deficit, but we gained. So we just capped our gains basically at 27,000 is what we did by writing that 27,000 call strike. Okay, so we're at the end of March and we have to write a new one. So we write a new one, and we write about a 20 delta call, and that's an April 28th, and it's 31,000, happens to be the 20 delta strike, and we collect $450 in premium for it. Okay, we can see all the way to the end of April, the blue line, that expires worthlessly. We just keep the $450, and guess what? We write a new one, right, for May. So let's write a new one for May. 20 delta strike happens to be 33,000. We collect $425 for that. In this case, we can see that, sure enough, the blue arrow is pointing, it expires way, way down, so we keep all the 425. May comes along, and we're writing June, the month we're in now. So June, we write 20 delta, but we only get $390 for it. The IV was quite low in June. If we remember, it was really getting low, and we were kind of like, we don't want to get too crazy on selling too much IV right now. And sure enough, we did have a big spike. It could have went down, could have went up, who knows? But we're still well within our 32,000 parameter. We've got a week to go. Of course, if the price of Bitcoin stays under 32,000 by June 30th, we will keep all that premium, that $390. But that hasn't happened yet. Who knows? So if we look at our scorecard, when we started in March, we actually lost $400. Well, it was $800, but we collected $400 in premium. So it's a $400 loss. April, we collected it all. May, we collected it and we kept it all. In June, well, we may or may not collect it all. So we're talking about $865 so far that's confirmed. But the thing I want to point out here is, let's say we came into the Bitcoin market on March 1st. We didn't have any Bitcoin. We bought one Bitcoin. We thought, no, we're going to buy a Bitcoin and we're going to do a covered call campaign. Every month we have this, we're going to sell a call against it. Well, the value of Bitcoin increased over $3,000, right? So you have to take that into consideration. Yes, there are some months, such as on March, where we sold a call and expired above that price. We capped our loss. That's all we're doing. We're still capturing gains, okay? So that's an important point there. Now, the next thing we come to is, some people say, well, why did you sell a 20 delta? Why are you choosing those strikes? There is no wrong choice when you're selling strike prices. Your strike is going to be determined, it's going to determine the amount of premium and how much upside, how much room to run you're going to give the underlying asset, whether it's Bitcoin or a stock or whatever, before being capped off. With Bitcoin, I mean, we just saw a move from about 25 and a half up to 30, 31. That's a sizable move, right? That doesn't happen every day. Every month, you have to go back and look at the averages, okay? It comes down to your sentiment and it comes down to your bias. If you're really, really bullish on Bitcoin, then maybe don't sell some covered calls, or you're going to choose a farther strike price. Maybe you're going to be selling 15 delta, further away from the money, okay? Now, it's very common for most people in the traditional TradFi world, when they're running covered call campaigns, they're probably selling anywhere sort of 15, 16 delta, up to around 30 on the high side. 30 is getting pretty close to the market price. And, there's, 70% chance it's going to expire in your favor, but 30%, 30 delta, things can change quick, right? So that's the typical range that you're going to see most people do. And the one thing, so the other day, so I think this is on Wednesday or Thursday, I made up this little chart. I said, okay, Bitcoin at that moment was at 29,000, almost exactly. So I said, okay, let's say I sold an at the money call right now on Bitcoin. If I sold the 29,000 call at that moment, it was actually a 0.55 delta, as you can see, okay, because we were skewed to the upside. We would have collected $2,200, $2,200. That takes us up beyond 31,000, okay, in terms of that premium we're receiving versus how much it could appreciate. So if we scaled it down and said, okay, we sold the 30,000 strike. Well, that was a 50 delta. We got 1750, and you can see the amount as we get further and further out of the money. Those strikes get further and further out. We're collecting less and less, which makes sense. The delta is going down and down. But we were looking at 33,000 delta at that time. That was a 30 delta call. I know that the 20 delta was probably like the 35 or something, or 34 and a half, or whatever it happened to be. But still, you can collect $900. So let's say you wanted to play it safe in this case and say, hey, what? I'm just going to sell the 30 delta call. I'm going to collect $900 in premium. That's pretty good. You're giving yourself a lot of room for that stock to move. That stock is going to run $4,000 more dollars after it's run from 25 it just made. I mean, it could. Doesn't seem too likely to me. It could. Anything can happen. But I'm not going to say it's free money, but it's as close to free money as you're going to get at that point. Now, of course, let's say that we're completely wrong. And at that point, Bitcoin exploded and went up to 40,000. Well, all we're doing, it's not a bad thing. We just didn't make as much money as we could have. We made the money between 29 and 33. So we made $4,000 there. Plus you got to add on the $900 we made. We just missed out on the appreciation between 33 and 40. Okay. And it sucks and we kick ourselves in the butt, whatever, but we carry on and move on. So that's how you have to look at these covered calls. It really comes down to your sentiment. You can sell an at-the-money covered call. If your sentiment is that the thing is going to stay sideways or even go down, why not? You collect a lot of premium.
Another way to think about if your covered call expires in the money, it's going to actually convert some of your bitcoins into dollars effectively, because it's actually delivering dollars. So you could think of that then as if you then next month sell the put at the same strike, and then you're hoping to get put back into Bitcoin. So that's if you're concerned about giving up the Bitcoins as opposed to giving up the dollar value, because some people will be doing this to accumulate more Bitcoins, and some will be doing it to accumulate more dollars. In fact, while you were doing that illustration, you said we made what, $850 or something over the 3 months.
Yes, I think so. Yeah.
Yeah. So that equated to 3.2% Bitcoin, a Bitcoin yield. So if you're a Bitcoin maximalist and you're looking to just do this to collect Bitcoin, then you were annualizing about 14% Bitcoin yield, which is better than you're going to get anywhere else.
And through a lot of this demonstration too, we were in a pretty low IV environment. So other environments, you would have, maybe that would have been 1,200 you would have made or something. So who knows?
Yeah, it's worth saying that. Yeah, because during the loss of the past month, particularly, the skew on Bitcoin has been negative, and that is the calls have been priced lower than the puts. So it's been a bad time to sell calls, and as well as the market dropping, the implied volatility was also dropping, which is quite a sort of a confounding situation. And so you were sort of forced into a position where you were selling calls super cheap, and actually, as my book displays, but almost in a situation like that, you might want to just take a pause and say, you know what, it just doesn't feel right. I'm not going to sell those calls. I'll just wait.
Okay. Hey, look at this. It's quarter two. For the first time ever, we're on time, and we cut it within 45 minutes. So we can probably go to a Q&A now. Once again, I'll just mention we've got the, if you don't have a Deribit account, sign up at the top, save 10%. There's a link up there. It's our link. And we do have a little special offer. Again, 7 days access, or 14 days access for $7 for Rogue Trader Academy. And I will put that into the chat as well. Okay, guys, let's go to Q&A, and let me just actually, Richard, if you want to take the first one, and let me just adjust the slide.
Yeah, sure. So the first question is from Luke. Isn't rolling? I'm going to insert simply postponing execution. So you're postponing the day of reckoning, and if you're in the money and you're rolling, then you're obviously looking to avoid being exercised in the money. Of course, what you're really just doing is buying a short-dated option and selling a longer-dated option or a strangle. But the real reason to do it, well, there's a few reasons, but the first is that you've got control over the book, over what gets expired and when. Because the last thing you want to be doing is sitting on at-the-money call and maybe put with 1 hour to go to expiry, and then suddenly some news comes out, the market moves $1,000 because the gamma's going to be horrible, and you're going to end up $1,000 offside. Whatever you do, there's no hedging it. So you kind of don't want to be in that situation. So if you are going to be holding to expiry, personally, I prefer to be holding a whole bunch of strikes and continually hedging with futures into expiry. And so to save myself the bother of doing that, because it's hard work, and it's something that market makers will do also with automated systems, so you don't have to. Better just to roll out of the position with maybe a day or two to go, go and sell it a week later or a month later or whatever takes your fancy. Maybe get a better strike, get further from the money, maybe get more premium, whatever your gag is. I personally use rolling to, if I've got an at-the-money position, as I mentioned to you on my book, I've got these at-the-money 1 week calls. The reason I want to roll them is not really anything other than I can get more implied volatility somewhere else. So I can buy those calls at 45 vol, sell them at 60, somewhere else and pick up those 15 vols over the next 2 weeks. So that's why I'm doing it. Yeah, I'm rambling again. I do that. I ramble a lot.
All right, that's all good. What else we got here? Can you set a price alert the Deribit TradingView? You know, that's an interesting question. I don't know. I'm not a power user on TradingView. I just happen to have it because it's got a little bit more functionality. I mean, for the most of what I'm doing, I'm using the charts in Deribit. But you know, TradingView does give you that extra functionality, and I know plenty of people who do set price alerts. And I have had price alerts come to my phone before, but I've never looked into having it with Deribit, but it's something I can look into. Do you actually have your own pricing, or just following the market price?
Oh, this is a good question because actually it's different for both of us. So Shane's using the Deribit screen prices, and I am in terms of measuring my mark-to-market P&L every day. So when I'm reporting the P&L on the books I trade, I'm doing it on Deribit marks because nothing else makes any sense. Because Deribit are going to give me margin calls based on what they think the prices are, not what I think the prices are. But actually, I do also have my own pricing, and I compare our model, my institutional model, with the prices I see on Deribit, and that gives me some guidance as to what I want to buy and sell. Yeah, so I will, if I think calls are too cheap relative to puts, for example, I will sell calls and buy puts and then hedge with futures. And if I think puts are too cheap compared to calls, I'll sell puts and buy calls and hedge the other way with futures. And if I think the long dated is too cheap and the long dated is too cheap and the short dated is too expensive, I'll sell and buy. So I'll do that kind of juggling. But on the whole, just trading what you see on the screen on Deribit is actually fine. The pricing engine they're using and giving you the indicative vols on the mid price, it's pretty good, and you know it's good enough. Good enough for government workers.
Government workers, yeah. The next question is a good one. Again from Luke. Can you long a perp instead of owning the asset for a covered call campaign? Yeah, and you know, in fact, not next week, but the week after, we're going to be talking. I think it's the week after. We're going to be talking about synthetic covered calls. And you know, traditionally, people think about a synthetic covered call as having a long dated call, like in the equity market, you buy a leap or something, and then you would sell, you know, monthly against that, for example, and then sell the leap at some point and close that campaign. But yes, absolutely. And in fact, what we're going to do is we're going to show you how you can maybe even 2 or 3x your return on covered call campaigns by using futures or basically a synthetic covered call. So look for that coming in the next 2 weeks. What else you got? Since your collateral is in Bitcoin, when you close on the covered calls, even if you made money because Bitcoin price is higher, you'll have less Bitcoin as collateral. You close the covered call. Yes, you're saying when your collateral is in Bitcoin, when you close the covered call, if you made money, because the Bitcoin price is higher, you'll have less Bitcoin.
I mean, you'll spend more Bitcoin to close it. Well, the thing is, if you're looking to accumulate Bitcoins, then you should just look at the Bitcoin value of the options, not the dollar value. Let me quickly share my screen again and show you that. So if we look at the price of the, say, 30, this is the July, yeah, the 30,000 July, you can see it's 46.83 vol. The price is 0.0701 Bitcoins per Bitcoin. So that's was that 70 basis points. So it's going to cost you that much to buy it, and you'll receive that many Bitcoins for selling it, which is equivalent to about $2,100 at the moment. And of course, if you sold this 30,000 call, then you'd obviously want to be buying it back at somewhere for something less than 0.07 Bitcoins. That's all. So the way you account for this stuff, whether in dollars or in Bitcoins, doesn't really matter. It's interchangeable.
So next question from Def. So when you wrote a call that gets close to the money, you roll it up. Yeah, ideally you can roll it out. We'll roll it out, but whether you roll it out and up is your choice. It really depends on the market and the sentiment at that time. But typically I'm rolling out and up just to give myself more space on both time and price. And we always try and do that for either a credit or a flat, so it doesn't cost us anything. Yes, and you want to do it before it gets in the money, ideally. Sorry, go ahead, Richard.
Yeah, I was going to say it depends, right? If you think that this, for example, 31,000 is overblown for Bitcoin at the moment, and I think there's an argument that says for it to rise from 25k to 31 without any kind of retracement, that would be unusual. So it's reasonable to say if you sold, I don't know, the 30,000 and you were $1,000 in the money on this one, you might think, well, I'll just roll this out to the next month at 30,000. So I'll just sell an in the money at 30,000. And effectively, what you're doing is selling a put with an embedded future, and that's valid too. Or you can roll to at the money, or whatever your particular strategy is. With a cover call campaign, sometimes you will get the market just come up and threaten your position way too early or blast through it, and you might need to just buy it back at a loss and accept that you're not going to get the same return for the next month's covered call as you are for the loss you've just paid. That just comes with the territory. Occasionally, it's if earning 12% or 15% a year unleveraged was risk-free, everyone would do it, and the rate you'd get in your savings account would be 15%, right? So the reason you're getting 15% is because you're willing to accept some risk of having to sometimes take a drawdown.
Yeah, good call. Another question from Jeff. What's the best to keep eventual margin calls in check and not be surprised? So I'm not sure if you're talking about margin level. We talk about having, using no more than about 30% maximum usually. I'm not sure if that's what you mean, Def.
Yeah, I think he does. So look, margin is your lifeblood in this game. It almost doesn't matter how much P&L you've got if you're private and you're not reporting P&L to anyone. What matters is that you don't run out of margin. So you definitely need to keep margin under control. And a great way to do that is to balance keep your delta close to zero. Is a great way to do that. So I'm hedging into dollars on my account, so I'm always selling perpetuals, which means I'm always delta neutral in terms of dollars, but actually delta positive in terms of bitcoins. So Deribit's margin system is always punishing me a little bit and telling me that I've got risk to the upside. But whenever that margin gets, at the moment my margin, maintenance margin is 60%-ish. That's telling me that I've probably gone a bit too aggressively. I sold too many calls when they were cheap, and I'm paying for that now. And I've just got to wait for all that time premium to come out. So basically, I'm just sitting here and making tiny adjustments to the book, pulling the gamma away from that at the money, reselling it as a strangle. That generally eases out the risk and keeps the margin system happy. But if you're at a point where it's all got a bit strong and you've got to sort of 70% margin use, then actually just consider taking some positions off the table. Just bite the loss and come back another day, because the lesson from my life is very, very clear, right? I've been trading professionally since I was 30. I'm 55 now, so 25 years. You've got plenty of time to make money. Don't be too eager to make a killing in one go, because you might just not do it. And if you blow up trying to make that fortune, you may not get another chance for another 5 years to come back to the table and try again. Mm-hmm. So I think I labored this in our first call of this series, right? Which is, whatever you do, keep your margin bills down. Make sure you can come back tomorrow. Deribit will thank you, and you'll thank yourself.
All right, next question from Luke. Ever considered using DeFi strategies to generate returns on your asset?
You're asking the right guy. Yes, I invented a product based around this, actually. which I won't name because it was for a competitive exchange. But and I was a huge fan of Uniswap V2, and I came to hate Uniswap V3, but I tried to see if I could find some strategies to use options to hedge Uniswap V3. And the thing about that is that you've got to be really careful which pools you are in, which parts of the liquidity you're taking, and you probably never quite make enough money in Uniswap to actually buy a perfect hedge in options, unless options implied vol are super low. I've tried it and I've modeled it, and in fact, it's harder than you might think. But I think you could definitely partially hedge a Uniswap V3 pool by buying some puts or buying some strangle.
All right. Next question from Gene. When do you take profits with covered calls? Do you wait till you reach 7% ROI? I guess, for example. So the example I used there, Gene, was I was taking that to expiry, no matter what happened, taking expiry, and that's one strategy people do. They say, doesn't matter in the money, out of the money, I'll just accept that. In Bitcoin, it's easy because it's cash settled. You don't have to worry about assignment, selling the shares at the lower price, buying them back at the higher price. You don't have to worry about that. It's a difference, and you carry on. Everyone has a different strategy, and we're going to talk about rolling and adjusting, I think, next week. I think whatever you're comfortable with. If I'm selling naked calls, I'm perfectly comfortable with taking those off the table, 20 to 25% ROI on them. If I sell them for $100 and now they're worth 75, I'll take those off and no risk gone away. I'd put $25 in my pocket. No problem.
But you're talking about naked though, not covered, right?
That was for naked.
Yeah.
For covered, you're probably going to want to give it a little more. Everyone's different. I don't think that most people use the profit target. Now, in the case, do you remember when we brought up the chart and we sold the call and the market went straight down? That call would have been practically worthless. Most traders would have just taken the darn thing off, regardless of their strategies, because what's the point?
Or even buy a call below the strike of the call you sold, so you've now got yourself some upside.
Yeah. There's different ways we could have looked at that for sure, but you're going to want to try and take most of that premium. So I think that the only time that people usually start to monkey with covered call campaigns is if they say, all right, if it goes against me and the market price gets close to my strike price or at the money, I'm going to roll it. So they'll make adjustments there. That's typically what they're doing. Otherwise, most of the time, they're just letting it go to expiry or until the delta becomes like a 5 delta or something and just taking it off. So there is no right answer for that. Whatever you're comfortable with. But if you want to say, hey, 75%, if you're in the money 75%, take it off, take it off. I mean, I'm a huge fan of getting rid of risk. Huge fan. Take the money, get rid of risk. And in this case, we're only selling 30 days. Maybe there's 8 days left. Who cares? You got to wait 8 days till the next one. That's fine. No big deal. So
we had one more. Yeah, I was going to say, I'm just going to add one thing, which is that if you are going to take your money off the table at 70% ROI, you could just think of that as an early roll. So maybe you could sell the following month with 5 weeks to run. So actually, the extra premium just goes into the next month, and you'll earn it a bit slower, but maybe more comfortably with less gamma. Sure. There was one question we've missed because it was in the chat section. I've just moved it to the question section. I think that was from Sylvanus. Yeah. If you're short 1x BTC. Then selling these calls will be a loss if price shoots up. If you're already short Bitcoin and price goes up, you're going to lose anyway. And if you then sell more calls, then that's like selling even more Bitcoins.
That's like a Texas hedge.
Yeah. If the question actually meant if you're long Bitcoin, if you own a Bitcoin and you sell a covered call against it and the price of Bitcoin goes up, then you are going to give up some of your Bitcoin, yes, because Deribit it delivers in the underlying currency. So you will pay you'll receive Bitcoin as premium, and if you allow your option to get further in the money than the premium you received, you will give up some of your Bitcoin as part of paying for it. And it's your choice whether you choose to accept that and then roll again so you're in the money, so we recover that Bitcoin in the premium, or whether you want to roll the position early to avoid actually having to give up your Bitcoin.
I think that's it. That's wonderful. Hey, you know what? We're at an hour, Richard.
I got one more from Jeff.
Okay.
This is a really, really interactive session. I've tried to buy back before expiry, but open interest was so low I couldn't close it. Oh, you mean liquidity was low? So that will happen if your option is getting deep in the money.
Yeah.
And one of the shames is that not all market makers quote all the high delta options. You can actually mitigate that by if you sold a call and it's in the money and you want to actually buy the call, then what you can actually do is you could sell the put and then sell some future and sell some future, and that would effectively close it. We need to cover that at some point.
Yeah, we would. And another thing I'll say there, Def, is that I've been in that situation before too, where something got in the money, and as I went to look, and there wasn't much of a market there. However, I will say this on Deribit: if there's a wide spread, and it's not reasonable to get out, put in your bid. If you, in this case, if you're buying a callback at the mark price, there's often someone there. They're hidden, but they're often there, and you'll get executed. So you think there's no open, obviously put it in at the mark price, which is the fair value price, and boom, it's done. So try that. And
actually also have a look at the combo trading screen. I'll just quickly show you that. Sorry to bore everyone, because I don't want to do Deribit a disservice here. If you go to the strategy section here and then go to combo books, you can actually create an RFQ for a position. So if you want to do a
RFQ is request for quote.
Request for quote, yeah. So you want to call counter spread, and let's say you wanted to roll 30th of June to the hang on, we want to buy the. So sorry, we want to roll 30th of June to July, 20th of July, and the 30th of June strike was say 23,000, say. So there's no market. You see, no bid, no ask. You can actually create an RFQ, and you can tell them how many you want to do and which direction you want to go, and hit confirm, and that will actually open up a market in this screen where somebody will come and quote you for that. So even if it's not, that price isn't available on the outright screen, you can often get a fill here on the strategy. And I'd recommend reading the Deribit Insights page about the strategy and combo screens.
Good point. Fantastic. I think that we've wrapped this up in record time. We've kept it about an hour, which is a record for us. So that's pretty amazing. Next week, we are going to continue on about the covered calls, because there is a lot to talk about. And covered calls, as we can see, is really effective at generating monthly income. If you're starting, if you're just getting into it, I think it's a fantastic way to go. We're going to talk about adjusting covered calls, rolling them. We're going to talk about synthetics, all this kind of stuff. So once we put all this information together, you'll have everything you need to run a proper campaign and start to generate some monthly returns. So, Richard, you got anything else?
Just finally, the poll. Apparently, according to the poll, if there's a revolution in Russia, Bitcoin's going to either do nothing or go up. So we should probably sell some puts. Or buy some puts.
Okay, so what happens if we lose on this trade? Who do we blame?
We've got a list.
We got a list. Everybody who asked us a question, it's your fault. Okay, wonderful. Thanks, guys, for joining us. I really appreciate it, and we will see you next week.